Hello, everyone, and welcome to the Brenneman Blueprint podcast. If you don't know by now, I'm your host, Drew Brenneman. I really appreciate all of you joining for today's episode. And for this episode, I'm going to do something a bit differently. I'm going to be behind the mic as a guest. So this actually was the first podcast that I ever did as a guest. I joined the Climb podcast with Michael Moore and Robert Wierema. So this conversation went differently than most of the podcasts that I've been on, to be honest, where we talked about real estate, obviously, but we also talked really a lot about mindset and some of the things that I was thinking or doing early on in my career or still do. So I really liked the questions they had asked me, and they were some questions I had never been asked before. And it's just a conversation that I really enjoyed. So I want to play that for you all today. And then also, don't forget, if you're interested in being a passive investor in real estate, you're more than welcome to go to brenneman.com, schedule a call with me, or sign up using our Invest Now link to be a part of our investor network and get exposure to real estate through our deals. So without any further ado, here's the episode.
We did not need any prompting or anything. I had money, I wanted to invest it, and so I bought property. And that's and I'm sure Chris would say the same thing. He wanted to do it, so he just did it.
All right, welcome to The Climb. This is Bob Wierema with my co-host, Mr. Michael Moore. Today, we're joined by Drew Brenneman. Drew started his first business at the age of 14 and launched a highly successful internet business all while in high school. Shortly thereafter, purchased his first rental property when he was 20 years old. Had a little stint on HGTV, which we'll dive into. Ended up at the University of Wisconsin-Madison School of Business with a focus in real estate and urban land economics. After graduating, spent time with 3 national real estate development firms to get some experience. And then in 2005, founded Brenneman Capital, co-founded the Blackhawk Investment Group in 2008, and finally, Dwell, the Chicago-based real estate investment and property management group in 2019. Drew, welcome to The Climb.
Great. Thanks for having me, guys. Appreciate it.
Well, there's a lot there and probably a lot of places we're going to want to go. So would love if you could just kind of start from the beginning. Where are you from? And tell us a little bit about your upbringing and then kind of bring us up to current state.
Yeah, sounds good. No, appreciate you guys having me on. I just listened to the episode with Matt Johnson, just kind of refresh myself what you guys usually talk about. Love that episode. And a year and a half ago, I listened to the episode with Chris Powers that you guys did. So actually, I guess, long time listener here and there. So yeah, all the stuff you mentioned, I mean, it's really just around real estate investing, all those different brands. I mean, it's really just been offshoots of different just sort of partnerships that I've started with investors or people who want to participate more heavily in the deals from like a workload or partnership standpoint. But yeah, I mean, got started really like in high school. I started this internet business just selling items in video games. So my friends are playing like Diablo 2 and EverQuest and these, whatever they're called, multiplayer role-playing games or something. And I didn't really like care about those games. Like I like playing sports video games or just other games, but they told me they're selling their stuff for real money on eBay. And so then I got interested in what they were up to. So from like my sophomore year of high school to freshman year of college, I just was buying and selling items. Like I'd figured out what the market was for an item in the game, and then I would just resell it for more. I remember just trying it out, thinking like, what can I get for like $20 for items? And I saw something selling for 5 or 10 that normally should sell for 20 plus. So I bought it and then resold it and did that like 10,000 times more. And all of a sudden had some money and tried to figure out what to do with it. And so then as a teenager, I started reading just all the books that probably most people, I don't know, read when they're like in their 30s or 40s, like Rich Dad, Poor Dad and Intelligent Investor. And so like those I was reading as like a 16-year-old. And I really liked how real estate investing sounded, where you're combining really like an investment and a part-time business. And there are so many advantages to real estate that I really like. There's a ton of tax advantages. You get cash flow. You can get high returns because you're leveraging the deal when you're borrowing money to buy the property. And then, and it's not really correlated with other investments. So it's going to perform differently than the stock market and other things that you would invest in. So basically, I've just started doing that when I was a teenager. So I bought my first deal when I was 19, and then I've just been going ever since. I'm 37 now. So it's weird to think I've been doing it almost 20 years. So
Drew, starting and having that kind of vision or curiosity that early on, I think that's certainly an outlier, not the norm, right? So were your parents real entrepreneurial, or you had what piqued that curiosity?
yeah, I mean, both my parents were teachers. So no, there wasn't any family business or entrepreneurs really. My dad's dad was an entrepreneur. He was in like the automotive sales industry. And then he went on to like start some restaurant and bars in northern Wisconsin. But I actually never met him. He died before I was alive. So I would like hear like, oh, you're just like Lou. But I've never really had any influence from him other than hearing about it. But I mean, a lot of it I think comes down to your mindset, and like what my parents did do a good job of is I'd say risk avoidance. So like if a lot of the ideas they wouldn't say like, okay, for sure you should do that. They would be like, they'll explain kind of how it will go wrong, but then don't tell you like, definitely don't do it. Where, I mean, a lot of parents or folks will be like, I think that isn't going to work and you can't do it, or there weren't really like a lot of like limiting beliefs. I mean, my dad often say stuff like you create your own reality, and just like things where you're not. So I guess a lot of it came down to mindset, where even as a teenager, I don't know why, I just always thought I could do it. I looked around, I'd see, other people where maybe they were older, but they didn't have any special skills or experience. I didn't think it was just they were maybe 40 and it took them 15 years to save up their down payment or something. And then they got started.
And talk about too, like maybe growing up, was it you, brothers, sisters, just you and your parents? Like, tell us a little bit about your story of growing up.
Yeah. And then too, I didn't answer where I'm from, I guess, either when you asked that. So yeah, I'm from the Milwaukee area. So I grew up in a city called Waukesha, Wisconsin. So I was, 40 minutes maybe outside of Milwaukee, let's call it. And then was pretty rural area. My neighbors down the street and to the right would have been a farm, kind of thing. So when I was a kid thinking about real estate, it was like building like subdivisions, or that was kind of the stuff I saw. But yeah, I have one sister. She's 2.5 years younger than me. She lives in Austin, Texas now. And then my parents are still in Wisconsin. But yeah, so grew up there. And then I went to UW-Madison for college. And then those jobs I had while I was buying deals on the side, I guess the first one was in Minneapolis. And then the next one was in Rockford, Illinois. And then I moved to Chicago, where I am now. So,
well, and the reason I think it's just helpful to understand where folks are from. And I mean, like Michael's point before, a lot of times there's this like idea that, hey, you went and bought your first property. It was, hey, my parents gave me a bunch of money, or you came from a bunch of money. And I love hearing the stories of people that are growing up and kind of what you said earlier, what your dad would say, like you create your own reality, right? Like you can go and do this no matter where you're from. You just got to kind of have a lot of that drive to want to get there and go and do it.
Right. Yeah. And in terms of the locations, I mean, these haven't like for real estate, the strongest markets, either, like where they've been fine. But yeah, it would have been easier, sure, if I had like some family money and grew up in like Florida or somewhere that's been booming my whole life.
Right.
So.
Right.
And Drew, you said you're how old now?
37.
Okay. So I guess 19, 20 years ago, how did the process go of qualifying for the loan? Like, did the banker look at you like, dude, where's your ID? And what are you doing in the bank? Or like, talk about that process.
Yeah. Well, one funny thing too is I didn't own a car when I was in college, but I had 4 properties at one point, so it was like funny where you'd go to the property on a moped. But yeah, there's no parking really in Madison. Going there, if you want to get to class, you either got to walk, ride a bike, or a moped. But yeah, I mean, and I had documentable income because I had the internet business. So not that you needed it. This was in 2005 when I bought my first property, and then I bought 2 that year, then 1 in 2006, 1 in 2007. And yeah, so no, I had income that I could point to from the business on my tax return. And then on the first ones, to get a lower rate, my parents co-signed on that. And then the other ones, I just got approved on my own, where the first one, it was like a $200,000 loan plus or minus. So that wasn't that big. So they were fine co-signing on that. But then some of the other deals I bought were $600,000-$700,000 loans. And so that they didn't want to be on those, understandably.
What was the first deal, Drew? Like what type of asset did you buy?
A duplex. So a 2-unit for 220,000. And I didn't know what any of the terms were at the time, but like a lot of people in real estate like to say, I want a value add deal, which means they can add value to the property. And so the rents were really low, and these things all trade based on like what they bring in for income. And so I raised the rents, made it worth more. I sold it a year later for 270. It was off and going.
You mentioned our mutual friend Chris Powers earlier, and I think he got his real estate itch buying rental properties to start out. Like for our young listeners looking for, knowledge and direction, do you recommend that route as like a gateway or an entry into the business?
I love Chris. I've talked to him once on the phone. Love his podcast. He's great. Yeah, I know he got started out buying, I think, houses around TCU, and then now got into a lot of bigger, better industrial stuff. But yeah, I mean, what's interesting, and whether it's me or Chris, a lot of times you hear these stories and there wasn't like, we did not need any prompting or anything. Like I had money, I wanted to invest it. And so I bought property. And that's and I'm sure Chris would say the same thing. He wanted to do it, so he just did it. So yeah, I'd recommend that's a good way to get started. I mean, especially if you have a job, you can get through FHA 3.5% down loan. So I mean, if you would need to save up some money to do this, but even if you just have a 3.5% down payment, and then you live in the property, it's required in it, but then you can get started. And yeah, anyone who wants to get started, I mean, that's what I would recommend is just you need to figure out how it works, I guess, in terms of like the buying process a little and how these things are valued. But on a duplex, it's not that complicated. And then I have a podcast too. And one guy who just started on his own, I had on Mike Henning, and he's been doing it part-time for quite a while. And when I asked him that same question, he said, everyone eventually buys a house. So I figured I could too. I thought that was like the best way to say it. So just say what Matt said.
I think it's interesting because when you were that young, you said you want to invest that money, right? And I feel like a lot of times at that age, you just want to spend that money. So you had a totally different mindset than what I would say a lot of people do at that age.
Yeah. And I did realize that at that time. And I do think that's, some of that I think came from my parents as well, because being teachers, you don't squander your money. It's hard to accumulate any money. So then if you do, you need to save and invest it. So we weren't like a big like spending family, I'd say. Like if somehow we were just given like as a family $100,000, which like never happened, but let's say if it did, my parents would have just invested it. They wouldn't have been like, oh, perfect, now I'm going to buy a Range Rover. Like that's not how we were raised. So I've always thought that. I still have a 10-year-old car. I have 200 plus million of property that I'm obviously, I guess I own a percentage of all that, percentage of it, and a percentage of the profits. But I still am like, I think invest first.
And going back, we talked a little bit about Michael asked a question on, some of our younger, or I won't even say younger, but newer investors into real estate. So knowing what you know now and what you've probably learned over the years of doing this now for 17 years, as you think about new investors, what would you tell new investors as they look to get into the real estate space? Any kind of words of wisdom there?
Yeah, plenty. Like I think on the first deal, like just keep it simple, where I'm actually amazed I see people pull these deals off, but I see people who maybe they'll somehow get like a following online, just kind of talking about real estate. And then they'll raise like a ton of money from a bunch of different investors and buy like 100-unit property that needs to be rehabbed as their first deal. And seems to me like a miracle they pull it off. And because I'm doing that now, but that's like, it's not that easy. So yeah, I would definitely start small and then just focus on the cash flow. And your first deal, even if you read so for my first deal, like I had read, I don't know, 5 to 10 books on real estate investing. And then I bought my first deal. And at that point, I feel like I literally knew nothing compared to what I know now. I didn't know anything except for like how to value the property, let's say. And even that, I didn't understand any of the nuance with valuing it. And I did fine. But it was what I think has helped me early on. And even now, for the most part, I focus on the cash flow. So if you're brand new, maybe you don't know, how people are valuing these exactly or anything about construction, but you should be able to look around at the other properties that are for rent and then figure out what yours should rent for. And then talk to whoever you need to talk to, your insurance agent, and look up the property tax bill and really understand the expenses. So what I did was I thought my mindset, and so this will be helpful on the first deal, was after all the bills, I make like 200 or 250 bucks a month, including me living in it. So worst case, I overpay for it and I screw everything up and the building has all these problems, let's say, but then I just keep it and I'm going to make 250 plus a month and pay the loan down. And like, that doesn't seem like such a bad worst case scenario. So yeah, don't start out with a renovation deal or some 100-unit thing where you're going to have everybody invest in it as your first deal, because there's going to be a lot of mistakes on the first ones. And like, just focus on understanding the cash flow and then your worst case scenario, so you just hang on to it. So fixed rate debt and understand your rent and expenses the most, I'd say.
Drew, you bring up some interesting points that I want to kind of dive in on, jumping in at an early age and not necessarily knowing all the details, but having the grit, desire, curiosity, etc. Almost 20 years later, like, are there certain things about real estate investing that just don't change? Meaning, obviously, economic conditions can change and interest rates go way up, or tax subsidies, or some kind of government program like a historical tax credit, if you're going to get into old buildings and bringing them back to life, can sort of change the numbers. But with 20 almost 20 years in doing this, like, what are the constants?
I think what people nowadays, they overcomplicate things. When those first 4 deals I bought in Madison, my underwriting, or a lot of people buying their first deal, they'd be like, I don't know how to use Excel or how to underwrite. I was writing it out on paper. I didn't know how to use Excel either. Like, when I said like figure out the rents and expenses, I did that, but it was on paper. Like, I would have a calculator, I'd add up what the rents were, but then I'd write it down on paper. Like, I didn't know how to use Excel and be like, okay, I'll calculate it. Then I'll run this model. And then I've done a linear regression on the rents and discounted cash flow on the value here. I've never heard of any of those words when I was buying my first deal. People were doing these deals before computers were even invented. And so I would think, like, what came to mind when you're asking that is, real estate is it's really simple sometimes. And so you don't need to overcomplicate it. And just like that first deal I was talking about, I know I'd make money every month. And then worst case, I just keep it. And then in terms of things and I think all the kind of things that popped in my head as you're asking it just revolve around sort of not overcomplicating it. Like, right now, interest rates are higher than they were before. And in a lot of markets, the properties, there's no debt on them. They would, let's say, yield 5% a year. So like, if you bought the property all cash, you'd make 5% a year, let's say, on a lot of multifamily assets. And rates are higher than that. And so it's a scary time potentially. But if you just kind of keep it simple in your head like that, that kind of avoids like, okay, I made this fancy model and then this is going to happen by year 3. And it's like, just think about it simply. It makes 5% right now. You're borrowing at 6. It doesn't, your debt's actually knocking your yield down. So you need to have a plan to get that above 6, or you're just betting on interest rates. So I guess I would just say keeping things simple. And then, yeah, not much has really changed the whole time I've been doing it. Interest rates go up and down, and values right now are really high compared to when I started. But it's just kind of the same thing. And then I would say just, get in front of the trends. I guess that would be the only thing that's changed. When I started, retail and office were more in favor than they are now as product types. And some newer, more like niche ones have emerged where a lot of people are investing in self-storage now, where that was not as much talked about in 2005.
Got it. Before I forget, we got to ask you, talk to us about this HGTV thing. And are there any of the videos we can go find you on HGTV?
Yeah, my friend, I don't know how he did it. He was able to pull the recording off of the TV, and I have it.
That's great.
Yeah. So that was just, I know it's funny. I'm like really not, I know I started a podcast now, so it doesn't make sense to even say this, but I'm really not like very promotional or even outgoing naturally. So, but that thing, like, so I didn't, when I was buying these properties, it never crossed my mind to be like, oh, I should like tell the newspaper and get in it or try to get on TV. But the Home and Garden channel, they were doing a show where it was what do you get for the money in different markets across the country? And they were doing Madison, Wisconsin, and they reached out to the Keller Williams office and said, do you guys have any interesting clients that would be good for this show? And my realtor's like, yeah, I just sold a house to a teenager. So they had, so I was the $250,000 house on that episode. And so, I mean, it wasn't, they was on for like a minute or and a half or something. So it was interesting doing it. But yeah, it was simple to just show the place you bought and say a couple things like what your plan is, what you're up to. So
I always laugh at those shows, and you watch some of them now, and it's like, I'm a hairdresser, and my wife is a school teacher, and our budget is $3.5 million. You're like, what?
Yeah,
this is wild. I'm in the wrong business.
I know. I know. I love that too. There was some meme or something going around where it's like what you said, but like a beekeeper, and they're looking for like a $8 million house in the Bay Area.
Bob, it's because those hairdressers have a lot of clients like you that pay $80 to have their hair look that good.
That's right. And you got to go 4 times a week to keep it this tight, Michael.
Yeah.
I'm telling you.
Nice.
Drew, I love that sentiment, though, of keep it simple. The limited real estate investments that I've done over the course of being interested in that and understanding how it works and value creation, and am I going to roll the profits of this one into the next deal, and the beautiful 1031 aspect out there, et cetera. I agree. I mean, where I get, and a lot of the time, because, and you mentioned this earlier, like I still don't know how to use Excel very well. So it's all like very simplistic, and I understand the market and trends and what's going on. And a lot of times it's more betting on the horse, the person bringing the deal, than the actual deal itself. Like, do I believe in this person and his or her ability to deliver on what they're promising? But when you get into the back pages of the deck and the promote to the GP and the waterfall gets like super complicated, it's like, okay, wait, but why? This wasn't this complicated on the last deal. Like, what about this one needs more pages in the back of the deck to make it a good deal for you, right? So maybe comment a little bit on keeping it simple. And is that an investment strategy that you carried forward at Brenneman Capital?
Yeah, it really is. I mean, I guess to give you some more on I can go through more like in detail too, kind of once I got past those 4 deals. But I bought my first 4 deals in Madison, and then I had moved to Minnesota after I graduated for my first job working for a multifamily developer. And I basically invested all my money at that point and wanted to learn how like the big dogs do it, was my thought. And so someone working there, an intern, I told him my story, and he had said, let's go meet with my dad. Maybe he'd want to buy some like property with us. And again, like with the teacher parents, I have no idea what this guy could invest. Maybe we're talking about like 10 grand. I have no clue. So I printed out a bunch of deals, and in this meeting, they really liked a $3 million deal. And I was quite surprised because that's, like $1 million down payment on a commercial deal, which I told them that. And they're like, yeah, we know. And we ended up buying that one of those deals that I had printed out. And since then we bought like $100+ million of property together, the 3 of us. And to actually get to the answer to your question, we kept it simple on that. Like, there was no fancy, like, here's like the set of fees we're going to charge, and then there's going to be a preferred return, and then we're going to do this multi-tier waterfall, which if people aren't familiar with like private equity or real estate, this is just how people allocate like the profits from the deal. Instead of doing all that, I think we had talked about that, like, hey, people do that, but then instead we just kept it simple, and we just split just straight up. Like, the dad gets 1%, the son gets 1%, the son gets another percentage, and I get a percentage. When you sell or refi, like, you get your money back, like that you put in. So you put in the money, we do the work, and we just split. And then that served us really well, because a lot of those deals we've never sold. So then again, like to talk about incentives for a second, with some of these structures that are most common, where there'd be you get a fee for buying the deal, you get a fee for running it, you get a fee for selling it. And this is money that the sponsor makes regardless of if the deal even makes any money. So then they have an incentive potentially just to push deals along and collect fees. But I guess if you do that too long, then you're not going to be in business because your return track record will be poor. Then there's a preferred return. So you need to make 6 or 8% or whatever it is. And then you start getting a cut of the deal and you need to return the capital. So basically what that all leads to is, hey, the sponsor wants to sell potentially early a good deal because they want to start getting some of their fee. So like, I think a lot of that comes down to incentives and then what's the person like. So one thing for me, I've explained that like the structure we like these different structures that I've done where it's the more simple one or just kind of the traditional one. And it's a lot of times people are surprised that like we did that because it's just so easy. And then they ask questions where they're like, what about if the deal, if the deal was really poorly and you still got a percentage where you never would hit the preferred return? And there's pluses and minuses, I guess, but I've always just thought like I'm putting the investor first. And so that's kind of never, there's some different nuances that let's say someone might ask about, let's call it. And then it's like, it's just, those issues never came up, I guess, not to get too in the weeds, like, because no one's thinking like that. Like we want to have the investors happy and do well.
You mentioned working for a larger group. Talk to us about that. Like, what did you glean from that helped probably move you into the next to start your own firm?
Yeah. And one thing too, that I almost feel like I need to give a disclaimer for why I got a job if you're wired like me, because that's another thing people will ask about, where I had a phone call on Monday with somebody where they want a real estate broker who I really like. He's got somebody who he wanted me to talk to. He's going to want to go out on his own, start a business, start investing in real estate, like basically start like a similar thing to Brenneman Capital. And though it crossed my mind when he's like, do you want to do this call? I did do the call, but the first thing I thought was, if you need to do a call, it's probably not right for you. Like where you don't need to, the actual call, he had some questions around the nuances of like actually some of the more difficult points of how to put these deals together. So he's like well on his way, but similar thing where I just never wanted to have a job, just to be blunt. Like this whole thing's has been totally natural for me. So it's like, oh, how did you do this? It's like, well, I don't know. I just saw people doing it and figured I'm like, we're all about as smart as each other. Like we can do it. And plenty of people are way smarter than me doing real estate and plenty aren't. So I just thought it's fine. Like I'll be able to do it. And I'd rather do this, on my own. And so, yeah, working that first job, that was all about learning. They actually do really complex deals. The company's called Dominium. They have 30,000 apartments, I believe, but they're growing really fast. Could be way more than that by now. And they mostly do tax credit, so affordable housing deals. So like the funding sources, it's not simple like my deals where I just reach out to people I know are on our investor list and they invest. They're going and they're winning these competitive application process to get tax credits from the states or the federal government and then selling them to banks or Berkshire Hathaway or whoever, and then turning that into actual cash that's then part of their down payment. So I walked into a place that was, but it was really entrepreneurial and doing really complicated deals. So I was only there for a year, but I learned a ton. There's another non-real estate lesson, I'd say, kind of right after that then I'll just hop to. So I switched working at Dominium to another company after only being at Dominium for a year, just really mostly because of the pay. There wasn't a reason, and I wasn't paid like a small amount at Dominium for being out of school for a year. But I basically got an offer where, it was almost like double the pay. But all this it's not a lot of money. Like I was like approaching 40, where I was getting paid like 50 or 60 grand at Dominium, and I was going to like, depending on the bonus, 75 to 100 at the next place. But I learned a lot less at the next company, where I worked there for 2.5 years. I feel like I probably learned about the same amount at each. And so in retrospect, from like a learning standpoint, when people are early in their career, I think I would focus more about getting to the spot you want to get into. So let's say you want to be in real estate investments and be on the acquisition side, but you have one offer and it's like 50 grand to start out at an acquisitions place, and they buy a type of property you don't really care about. Maybe you want to do multifamily, but they're buying shopping centers. And or you could go work and be still in real estate, but maybe something different, like you'd be on the debt side or in property management, but you'd be paid way more, let's say. I would definitely every time advise people just get to the spot you want to be in. So take that acquisitions job. Now you have acquisitions experience. And in 2 or 3 years, you can just, you have 2 or 3 years experience of where you want to be. And then you can get the actual job or position you want later. But I oftentimes sort of talking to people, I'm saying like, get to the spot you want to be and then worry about pay and other stuff later.
It's great advice because I think a lot of times you come out of school, you see it. I mean, I've had this conversation with my cousins and they're younger and they're like, well, I want to go make a bunch of money and come out and they get this offer. And then you look up in 3, 4, 5 years and it's like, well, I want to do something on my own. And like, well, but now I'm making this money and it starts to get more and more challenging. If you have that conviction early, it's like, just jump and go and do it. Because what's the worst can happen, right? I mean, you're 22 years old, whatever.
Yeah. Or even within your example, like if whatever you really want to be doing, like get to the spot of doing that, where if you wanted to be doing something, but then you could be an investment banker and make double the money. But when you're 22, like double the money is not going to be a lot of money when you're 40, so then you're getting like your experience is not relevant to what you want to do for 50 grand, where when you're 40, if you're doing well, like that becomes a lot easier to make. Yeah. So that's spot on what you're talking about.
You went to this other spot, you're there 2.5 years. Then you jump to starting your own, or how did that kind of all shake out?
Yeah, really what I did was I was always on my own to some extent so I bought those properties when I was in college and then I start working in Minnesota, but then I meet that family and we start buying deals, I'll call it on the side of working at Dominium. We weren't buying deals where it was competing with them. So I never really saw it as a problem, where our first 6 deals in Minnesota were commercial ones. So shopping centers, an office building, an industrial deal. And multifamily was all that Dominium did. So there wasn't really any overlap. And then the next place. And so really like in that brand is called Blackhawk, which when you mentioned that in the intro, like we started that together, the three of us. And then we started that together, the three of us. And then I did that I would call it on the side for let's call it 3.5 years. And then at that point I went full time with Blackhawk and the Brenneman Capital brand. That's kind of like been always like my personal brand. So like kind of in the background are those first 4 deals. And now what I'm doing most of the deals out of is like a brand. But yeah, really. So then that's just another learning lesson there too, that like it's really difficult to start, like just like a cold start. I'd say like if the story would be, okay, I worked at those places for 3 years and then I met those guys and then I quit my job that day and then we started looking for deals. Like you're putting a lot more pressure on yourself financially and just getting this thing to work. So what I did was I had, and it's was fortunate we were doing different types of deals because this wouldn't work if we were just doing the exact same thing as the companies I worked at. But when I quit my job, and this would be in 2012, or in 2011, I had 2 of the deals in Madison still I owned. And then we had 5 deals in Minnesota and then with a 6th one on the way. So at that point, I didn't really need the income from the job anymore. And it was like, it just was like it's getting in the way of the next deal. So like, that's the time to quit then. So, and that was like a difficult time, where if you explain to people what you were doing, where it's just like, what was your life like for those 3 years? I basically only worked. I bought $30 million of property on the side. Like you find the deal, you're making a phone call on your lunch break while you're driving to lunch to the broker or your lender. Then you go home and you read the leases and you're doing the due diligence on the property. You're doing the purchase contract, you're reading that on a Saturday. And it's, so for 3 years, that's all I did. And it's a little different now. Not that different though. I'm pretty much still working a ton. Didn't really feel like work, especially as for yourself on the nights and weekends. But that would be sort of another thing where even if it's not real estate, just any kind of business thing, if you just kind of cold start it and go, okay, I quit, now I'm going to start it. those first deals, I didn't get paid, I don't think, for a while on them. So if I would have had no money basically coming in that first year or second year, so that's how I was able to do it.
Drew, talk about some of the sacrifices you made. You said I only worked for those 3 years, like I worked. So you worked your ass off. Anything you look back on and you say, I sacrificed this, or maybe I would have done this a little bit different?
Yeah, that's a good question on the what to do different piece where, yeah, it made a lot of sacrifices, but they felt, I can't really think of something where I'm like, wow, I really wish I didn't do that. Where even when I quit my job, I moved to my parents' house for a year. So in 2012, I lived there just in the basement where just to further save money. I had money saved up and I wanted to extend my runway more. I knew we had kind of invested what that Minnesota guy wanted to invest at that point. And so I was able to take a bunch of trips just internationally and stuff. So I was like, I'll just save money and keep all my stuff at my parents' house. And I went to like 10 or so countries in that year. It was great. And so in terms of I've done a lot of things like that, like, just live in my parents' house when I'm 26 for a year, which like a lot of people that's like their nightmare, but it just felt really natural. So I don't know if there's anything where I'm like, I wish I didn't do that, to be honest, where I felt like it was needed and I don't mind making the sacrifice. I like really working ahead, if you will, too. So then let's say we have like a contract that we are going to send out. Like I like to always be like one step ahead, think of it like chess or whatever. Like I'm always trying to be a couple moves ahead, and that's hard to do unless you're going to potentially put in more time. So if we have a contract, first of all, I would like our attorney to draft it. So then it's got already everything we want in it from the get-go. If someone else's contract, everything you want, it's like a change that then's like, bright red or whatever color it's going to be in. But then it'd be like, no, we got the contract. I need to read it this weekend and then we'll flip it out on Monday. I don't know. There's really not anything I can think of. I have a 5-year-old son now. When he was born, I took like 3 months off for paternity leave, let's call it, where I didn't do too much during that work wise. I've been able to do still what I want, I'd say.
All of these realizations or the ability to pause for a second and say, I need to make this sacrifice, or I need to make the birth of my son a priority, to me shows like this wisdom, right? And I think about the people that I know in real estate and investing and creation of value. And the ones that are really good seem to have this ability to, back to your analogy of chess playing or seeing 3 steps ahead, like they've got this, and I don't know if they're just lucky and they were born with it, and this is kind of getting to my question, or you hone that skill over time, but how do you develop the ability to see 3 or 4 steps ahead in the real estate space? Because to your point, it is a very crowded space. It's incredibly competitive. It doesn't take long at all, if you're interested in real estate, to have 10 deals on your desk to potentially invest in if you want to. So talk to us a little bit about how you've honed that ability to see a couple of steps ahead and bring that back to your investor base.
Yeah, I guess really I'm not sure what I've done to hone it. I've just always thought that it's really important. So I've just seen a high value in it. So I guess that's what I'd encourage if someone is like, what would be the tip? It's like, this is important and treat it as such. Like you're going to do a deal, there's going to be this contract for purchasing it or whatever the important thing you're working on is, and treat it like that. Like think, okay, if we ask for this, what are they going to do? Then how's that going to look? And like actually like treat it like it's important and take the time to do that. And then the other thing that I've done, maybe that's a little different, is like a lot of people talk about long-term thinking, but we're actually doing it and living it in some of our deals. Like a lot of folks, like for them, like owning a property for 1 to 3 years is normal. A lot of our stuff we own for 7+. That first deal I was talking about that we printed out in that meeting, we still own it. That was like 14 years ago. We bought that and we're just going to keep it. So And yet like there's a payday if we sell it, but it's in everyone's best interest, I feel like, to keep it. So that's what we're doing.
Tell me more about that philosophy, because I think that at least some of the stuff I seem to see and come across these days, a lot of them are that quick flip, let's go make some money. So talk a little bit more about your philosophy on the longer term hold.
So a lot of people, right, it looks great to have a high IRR, which is like a time weighted return metric. But if you think about how did like a lot of these, say, families get wealthy in real estate, they weren't going and whatever, like putting in the newspaper, we just did a 50 IRR, 9-month hold. Like they bought a property in New York or Chicago or LA, and they've owned it forever. They bought it for, it's this, like there's someone that I bought a deal off of in Chicago where his dad bought like 30 or 40 duplexes in Lincoln Park, which is one of the nicest neighborhoods here, for like 50 grand each back in like the 60s and 70s when it was like, dangerous. And yeah, and I know another guy who bought all the retail around the Whole Foods there in Lincoln Park when that was like where like the riffraff was hanging out. And they've just hung on to those. They still own those deals. So they've owned those for whatever, 40 years, these duplexes. And he probably could have bought those, he bought them for, let's call it 50 grand each. And maybe he could have sold them for 60 or 70 real quick and made a big return, would have doubled his money if he would have sold those. But now he's, 50 times his money, because those are all like $1 million duplexes in that neighborhood. So a lot of the money's made in the waiting, that's not in a lot of investments. And especially in real estate, it's expensive to transact. You're paying your broker, you're paying transfer taxes, you're paying income taxes. There's a lot of cost to transact. And so if you have a setup where people are in the deal longer, like you're going to make a lot more money doing that. Maybe your time weighted return would be lower because instead of having that big pop in a year or two, it's 7 or 10 years later. But the amount of money you make is a lot more significant. And I kind of always knew this was the case, but we actually then calculated it now. But where comparing just like a strong 10-year hold versus like 3 back-to-back 3-year holds, how does that look? And you need to string together like 3 pretty amazing deals to get after you pay all the cost to buy and sell, then buy and sell again, and then sell, like to be comparable. So I think it's a business that rewards the long-term thinking. And again, even the structure we did in that first deal, a lot of times it's interesting to just say, I didn't charge any fees. I just took a % of the profits. And you get a wide range of responses where it's like, wow, I'm surprised you did that. Like you didn't get any money up front. And it's like, no, but like this percentage is worth really a lot if I'm just patient. And so, or other people will say like, oh, I'm surprised he gave that percentage to you guys. Was fine with that. But but we weren't taking any fees or anything. We were just totally like shoulder to shoulder in that. If this thing makes no money, then we shouldn't make any either. And where you're signed up for like pro rata losses as well. If this thing sucks and loses money, then we'll add money like at our share. So
I love that. I love you said a lot of money is made in the waiting, and that really just stuck with me I think a lot of society today doesn't think in that way. It's like, give me those quick hits. You're going to make, to your point, every deck that I have seen come across my plate, like the first thing is like, look at this IR that we've returned on these past 7 deals, and we did it in 18 months. You're like, okay, well, what about all the other ones that you're not showing me right now too? I'd like to have an idea what some of those look like.
Yeah. Or and you can still generate high returns. It's just like, well, don't be trading in and out of these so long. I mean, like if somebody, like this, especially the last, 15 years, the real estate market's been on a great run. You would have probably been better off just keep everything, just try to figure out a way to buy more. So,
Drew, where do you think we go, as a society, maybe out 10, 15, 20 years, when you look at the difference between like home ownership versus renting, right? And home ownership sounds really good. It's the American dream. The government wants you to do it, et cetera, et cetera. which I totally agree with. But at the same time, depending on where you are economically in that cycle of your life, if you're just getting started or you've had some large event occur in your life, sort of midstream or whatever, home ownership has a lot of expenses to it as well, maintenance, taxes, etc. So as we think about, economically where we're going as a nation, does renting and multifamily grab more market share over time? Does it pull back? Like where do you see that going?
It's going to grab more. That's one of the things we like about it. The home ownership rate's been declining, just like a long-term trend now. And I think I still see a lot of value in home ownership. So there's no doubt that's not going anywhere and still be like a dream for most. I think what's different is there's a lot of people where they're just never going to be in the position to buy a home. They're just never going to be able to save up enough. I mean, we're getting into more of like a lot more just people that are very wealthy and then people that are just they're just scratching to get by. And so like that, I think is like a big factor. And then also the flexibility where, people really value flexibility today. I'm sure, anybody you guys are hiring, like they want to know what's the work from home deal here. And, so then, and they would apply that to where they live, where, okay, I'm in Chicago now, but maybe in 2 years, I want to live in Miami, so then you wouldn't buy a home now. Whereas in the old days, let's call it, you would have tried to buy a condo or something in Chicago to make some money. If you're going to be here for a short period of time, or you really value that flexibility, you're not going to do it. And then if you're around my age, like you basically saw everybody get burned with home ownership. So then you don't, in 2008. So you view it differently than someone who just saw homes go up from whatever the beginning of time to 2008 and pretty much never drop. Do you have just a different lens? Where I know my dad, when he and my mom, they bought a house in the early 1970s when interest rates were like 12 or something. And dad's like, if I didn't buy a house that year, I never could have. For homes, everything was going up so fast. So it was like a scarcity kind of mindset, like risk, a fear of loss almost in his mind, where today it's the opposite. It's like these things, I don't know if I really even need this. I might be moving and it costs a lot to buy and sell, then I'm locked down. And I think it's going to continue declining, not to like a insane extreme, but where there's people are really value flexibility. And then a lot of people view it differently now as well.
I love, Drew, you're hearing the same thing from your dad. Like his interest rates are going up. My dad's like, when I bought my first house, I'm like, Dad, I've heard this story enough times. Like, you boys don't understand. I'm like, geez.
Yeah. Back when college was $1,000 a semester or something.
Right.
And he walked uphill both ways to school, right?
Yeah.
Mm-hmm. No, I mean, I do think that's interesting. Like my wife and I were just talking about that a couple of weeks ago. We've got a 17-year-old, so she's a junior. She's got one more year, and then she's off to college. Likely will be out of state. And then our youngest will be in ninth grade next year, so 4 more years. And so you like the light at the end of the tunnel of empty nesters is like right there. And it's like at that point, if they're both out of state, and let's just say there's 5 or 6 states in between our 2 daughters to travel to see them, if they still want to see us at that point, like, does it make sense to have this home that we've built in Fort Worth, or at that point we'll have owned it 6, 7, 8 years, more have a lock and leave type scenario where it's just easy for us to hit pause on life in Fort Worth and travel anywhere we want to without the maintenance. And Texas doesn't have a state income tax, which is awesome, but our tax rate on our homes is insanely high. So the long-term cost of ownership is something you really got to think about if you're only spending 2 or 3 days a week there, or 4 days a week, right? So yeah, I agree with you. I think it's going to be interesting we'll have you back way before then, but over the next 10, 20 years to really see what, is home ownership as important as it used to be, say, for our parents' generation? Or is it flexibility? Flexibility wins the day, and that's what people want. You could have a second or even a a third place to stay in the places that you go to most.
Yeah. And I think people put a lot more value today, if it's employee working somewhere, I mean, they put a lot of value on like what's the company's culture like, or what's like the mission here, and you can kind of follow that through to everything, where like if that person's, main goal would be, I want to be able to have the flexibility, like in your situation, they're going to say, yeah, let me downsize to a condo and, and then have a lot more flexibility, or right, like one of those lock and leave neighborhoods where it's like gated or set up where people aren't there all year.
I mean, like you, Drew, I live basically down the street from you, but when my wife and I were getting our place, we're like, what else do we need? We have an area we live in and we got a bedroom. Like, we don't need all this stuff, because to your point, Michael, like, we want to go travel. We want to go go to Park City for a month and spend a month there. And, we have more flexibility to be able to go do those things because we don't have a $10,000 mortgage here in a big house with a bunch of rooms that we don't go into.
Yeah. No, and I think too, and depending on what people were doing for work before, where if you had to show up to a factory or to this one office every day, like you couldn't go to Park City for a month. Like now, if you're able to do that with your job, then yeah, why not have your housing situation match? So,
Drew, you mentioned it a couple of times, and I want to make sure we capture it, to promote what you're doing as well. But tell us about your podcast.
Yeah. So about a year ago, I started a podcast called the Rise and Invest Podcast. I'm going to rename it to the Brenneman Blueprint. So depending on when this comes out, it'll be under one of those two names. Or you can, I'm sure if you type me into whatever podcast thing, that'll come right up. But yeah, it's a real estate investing podcast, and it's for active investors and passive investors. And so passive investors would be somebody who just wants to not actually be the one doing the day-to-day running of the deal. They just want to be an investor in somebody else's deal. And so really it's for both audiences, where like, and I kind of cover both in my day-to-day, where I'm an active investor, but then our investors. So if anyone wants to invest in our deals, they can as well. For that, you can just go to our website, brenneman.com. So B as in boy, RENEMAN. And then there's plenty you can learn to make yourself like a better passive investor. So like we try to get into that. And that's something in the new year. I'm going to spend more time on getting more into the passive investor content, where we've had a lot of active investors, real estate entrepreneurs so far in like the first year. So.
Oh, that's awesome. No, and we'll put everything in the show notes too, so it's there for folks to go and find.
Drew, I got another question for you. I think we've been throwing some softballs your way, so I'm going to throw a curveball now. You're with a podcast out there, and obviously strong base of investors, and your philosophy. It's known, right? You've got publications out there, and people know kind of who you are and how you do it. Tell us something that people don't know about Drew.
Good question. The first thing that came to mind is, and I don't know if this is already out there, but like, so we talked about all the things that like a lot of the things that I've done work wise. And also like, there's just a lot of other things that I did and tried, but they weren't as much of like a long-term thing. Like, so my real first business, I guess when you said age 14 or whatever the bio said, the real first business was I was a magician. And I've done other things like along the way. Like at a wedding where my aunt and uncle got married, there was a magician there and he taught me some tricks and I liked it and just kind of ran with it, started doing kids parties. And then also in college, I was, it wasn't enough, I guess, to be doing those real estate deals and going to school. I also started a vending machine route that I later sold. And then I also did some network marketing at the same time. So I've just done a lot of different things. And so I just always, I know it's like the recurring, the big hit, if you will, was the selling those video game pieces and then real estate. But yeah, I would just I'd never been afraid to start something, but also not afraid to wind it down too. So where vending machines or magic wasn't my calling. So yeah. And then I think too, like, I guess one thing like where just kind of to bring the story to current where, so I had mentioned that the maybe just talk about resiliency for a second. Like the family that I met in Minnesota, it was me, the intern, his name was Brian, and then his dad Jim. So we bought property together 2008 till through now, but in 2019 actually Brian passed away. So he was 2 years younger than me, and so I thought we would just be doing Black Hawk just basically forever, the three of us. And so like I guess you'd never know how quick something can change, like where that just kind of threw everything kind of up, and like you thought you had one plan and now it's like totally different. So that brand, we went from thinking that's somewhere just going to keep growing to now kind of almost like a little more on autopilot. Like we didn't sell all the deals or anything, but then we're not like in aggressive buy mode like we were before. So I had to make a pivot. And then that was more about pushing harder on the Brenneman Capital brand. And it's crazy how things work out. I mean, probably in 2018, we had maybe 100 million of property. And it's in the last 3-4 years, I bought more than that. So I've more than doubled it, just where now I kind of got whatever, your feet thrown to the fire, back against the wall a little more again. And so it's just crazy how things work out sometimes. So, and just kind of, I don't know, I didn't feel sorry for myself or anybody really. I just kept going. So
Michael, you want to give him a wrap up question? Your usual. Drew's listened, so he might have something prepared for us already.
Well, yeah, we'll see here. So, Drew, in thinking about this podcast and why Bob and I are passionate about it, right? The climb, crossroads, and defining moments. And we've certainly captured those, and you certainly had them in your career thus far. And we definitely look forward to having you back and hearing what multifamily looks like on the horizon in the future. So, one of the questions that we asked towards the end of the podcast is, there's the saying, it's not what you know, it's who you know. But we flip it around and say, it's not who you know, but who knows you. And so in thinking about this podcast, capturing your story, and I'll let you pick, because I think you've got different avenues we could take this question. But if this podcast is meant to capture your story and get people to really know you, whether it's your family or your investors or the people that you work with, like, what do you want people to know about you?
Yeah, that I don't have a prepared answer. The episode I listened to, the question, that I think you had asked was, who do you want to know you? And of course I was going to say my son, but I mean, I think really what I feel like I sort of have stood for this whole time is like, really just like I wasn't afraid to go for it, and I wasn't afraid to do the hard work. I enjoyed doing this, so it's never felt like I was taking a big gamble. It's interesting. People often ask, like, are you like stressed out doing this? Because my dad, he was a woodworking automotive teacher, so he thinks about like the physical aspects of these deals. Like, so I like literally own thousands of toilets and thousands of doors, and just like so much stuff could go wrong. I'd never think about it. Like that's like included in the budget for your deal. Like there's repairs, there's CapEx, there's same thing with the loans or the leases ending, where I owe 9 figures of debt that I'm responsible for. And like, but we have revenue. So I guess where I'd say, not afraid to work hard and to go for it. I just never was wired to just be sitting there just working like a job. It just didn't appeal to me. I'd rather just go for it. And just the same mindset. I saw Mark Cuban say this on some Instagram video where it was him on Shark Tank, where he's like, I'd rather make 50 grand a year working 80 hours a week than 100 grand a year working 40 at a job. And sorry, I screwed it up a little. The 50 grand was working for himself, obviously. So I've had that mindset just the whole way through. And I think too, just kind of one thing that came up while you're asking the question, like it's very important to network, get your name out there, where I meet this investor and it seems so almost maybe easy as I'm explaining the story. And then I was able to meet other folks who invest in deals. But I've explained my story, this same thing, like thousands of times. And it's worked out in terms of finding like a partner or investor capital, like a dozen times, like where it's not. And I had a couple big hits, like those, like career changing event, like meeting that family in Minnesota. But it was, it's important to get your story out there and to network. So it is, I love the question here at the end. So
But look, that work ethic and drive and just ability to believe in yourself, like we need a lot more of that in our people coming up, and people mid-career and even towards the end. You got to have that grit and drive. And I firmly believe in what you say. Like, if you love what you do, and you're passionate about it and you're interested in it, A, people are going to be attracted to that. And B, I think most importantly, you're not really working. You're doing what you were put on this earth to do, I think. So thank you for sharing that with us. And this has been an awesome podcast. We'd love to have you back.
Yeah, that sounds great. I mean, thanks for having me on. Really appreciate it, guys.
Awesome. Thanks, Drew.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcasts. Dive deeper into real estate investing on Brenneman Capital's website, brenneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Brenneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.